As we move into chapter 17, it's important to realize your perspective from this chapter. So when we talk about debt, and we talk about stock in this particular chapter, we're talking about your organization purchasing or investing in another organization through a debt investment or a stock investment. We are not talking about the issuance of a bond. So you are not borrowing money. This is not a debt to your organization. It is where another organization has a debt to you. This is not stock in the case of equity or common shares in your organization. This is your purchase of shares in another organization. Maintaining that perspective is really important through this entire chapter because it is a different perspective than that of the organization when we issue debt. So when we sell bonds or when we issue stock or sell stock, we are the purchaser from this perspective, not the seller. I want to make sure that everybody is very secure in that because there will be a lot of confusion potentially as we move through this chapter. And I would much rather you take the time and secure yourself in your perspective ahead of time than have you try to undo this mid-journey. This chapter covers investments in debt securities, investments in equity securities, and some financial reporting issues related to those. You're going to learn a lot about classifications, thresholds, and how we need to treat those from an accounting perspective. When you're done with this chapter, you should have an understanding of the accounting for investments in debt securities, an understanding in the accounting for investments in equity securities, be able to explain the equity and the consolidation methods of accounting, and evaluate other major issues that are related to investments in debt and equity securities. There will be several videos that go along with this chapter. We're going to move through it very detailed and work on quite a few problems while we're together in class. So let's start talking about the investment in debt securities. Why would somebody invest? Why would somebody purchase a bond? Well, they may do that to earn a high rate of return. They may do that to secure certain operating or financing arrangements with another company. So, for example, a debt security in and of itself represents a creditor relationship with another entity. You are their creditor. This can be U.S. government securities, municipal securities, corporate bonds, convertible debt, commercial paper. There's a lot of different types of debt securities out there. We do not consider the basic trade accounts and loans as debt securities because they don't meet the definition of a basic security. In some instances, you will enter into an arrangement with another company. So, for example, you will invest in their debt and perhaps they're going to invest in your equity. There's a lot of relationship-based motivations for investing in another organization. Companies account for investments based on the type of security it is, whether it's debt or equity, and their intent with respect to the investment. So a debt investment is going to be when we are a creditor. An equity investment means that we are going to be a partial owner. Management's intent with respect to the investment is the key here on how we will treat this. Is there an intent or not to sell this particular security? And whether we intend to sell it or not is going to depend on whether or not for debt we use a amortized cost valuation approach or we use the fair value approach. And for equity, whether we use the fair value approach or we use the equity method approach. We'll get into this more in depth as we move through this chapter. I just want you to realize that it really does come down to what is management's intent when they purchase the security in regards to that security. Now, intent can change over the course of the time we hold a security. If intent changes, then of course we're going to have to make adjustments with those changes of intent. Debt securities and their representation as a creditor relationship are evidenced in the holding of U.S. government securities, municipal securities, corporate bonds, convertible debt, commercial paper. One of the motivations for this may be that you have in excess of cash on hand and you need to invest that so that it is earning some sort of a return for your stockholders, but perhaps you are risk adverse, so you invest in very, very stable U.S. government securities or municipal securities. One of the bonds that you may invest in is some type of a renewal bond for an area, because that renewal bond is going to result in regentrification of an area where you will be able to build your new store because you own a piece of property in there. As that area builds up, then that's going to represent a positive effect on your organization overall. Not everything comes down to necessarily how much interest you are going to earn. What it may be doing is it may be facilitating something that you need in order for your business to grow. There are three basic accounting categories in regards to debt securities. They are held to maturity, trading, and available for sale. These go back to that management intent. What is management's purpose for having this security? Held to maturity securities are debt securities that the company has the positive intent and the ability. They have to also have the ability to hold to maturity. Trading securities are debt securities that are bought and held primarily for sale in the near term to generate income on short-term price differences. So this is more of a playing the market. And available for sale securities are debt securities that are not classified as either held to maturity or trading. So they're kind of the middle ground. How we value these depends upon which category they fall in and what the unrealized holding gain or losses impact is, where it's recognized, and what other income effects there may be, such as when interest is earned, and whether or not there's gains from or losses from potential sale. You notice here we have the fair value and then we have the amortized cost. Amortized cost is the acquisition of cost. So like our historical cost, adjusted for the amortization of discounts or premiums, if that is appropriate, depending upon that specific security. So let's talk about held to maturity securities, which are valued at amortized cost. They are not held at fair value. The rationale for this is if management intends to hold certain investment securities to maturity and has no plans to sell them, the fair values or the changes in selling prices really are not relevant for measuring and evaluating the cash flows that are associated with these activities. The effective interest method is applied to the bond investment in a fashion that is very similar to bonds payable. The investment carrying amount is increased or decreased by the amortized discount premium in each period. The only time you are allowed to use the straight line method is if it would yield a very similar approach, so that there is no material difference between effective interest rate and the straight line method. To illustrate this, we're going to use Z Company, who purchased $1,000 of 8% bonds of Bush Corporation on January 1st, 2016. They purchased this at a discount, paying $92,278. The bonds mature January 1st, 2021, and yield 10%. Interest is payable each July 1st and January 1st. Z. Smith will record the investment at the point of purchase as follows. They have $92,278 in debt investments. That is an asset account. We increase an asset account through a debit. And we paid or remitted $92,278 in cash. Now remember, we're going to have to use a schedule of interest revenue and bond discount amortization through the course and the life of this particular bond. We plan to hold this until it reaches maturity, meaning that we will receive a full $100,000 when we hit the maturity date of January 1st, 2021. We create this schedule showing 8% bonds that were purchased to yield 10%. We start with our initial cost, our historical cost of $92,278 as the carrying amount of the bonds on January 1st, 2016. As we receive our various amounts of interest, we will then calculate, so every 6 months, we receive $4,000 worth of cash. That's $100,000 times 8% multiplied by 6 out of 12. But this does not represent what our actual interest revenue would be. Remember, we purchased these at discount. We will be receiving $100,000 in 2021. So we take the $92,278, multiply it by the 10% yield, multiplied by the time, and that tells us that, in effect, by purchasing it at a discount, we are actually subject to $4,614 worth of interest revenue. Now, some of that we will not receive until we receive the full face value of the bond in January 1st, 2021. We received $4,000 of it now, leaving $614 of it that we will receive when the bond matures. We add this to the carrying amount of the bond, and then we continue this same process for every interest period until we reach maturity. When we reach maturity, we will have amortized the bond discount of $7,722 in full and have a carrying amount of the bond of $100,000. At that point, we will receive the full maturity value of $100,000 from the organization that we purchased the bond from. To record receipt of the semi-annual interest payment on July 1st, we will make this entry. We received cash of $4,000. We add to the debt investment the bond discount amortization as $614 and recognize the full interest revenue of $4,614. Now, our friends at Z Smith are on a calendar year basis, so it's going to have to accrue the interest and amortize the discount as of December 31st, 2016. It does that by recognizing an interest receivable, so they are expecting to receive cash of $4,000. $645 is attributed to the increase in the carrying amount of the bonds, and total interest revenue of $4,645. How this would reflect, based off all of this, on the balance sheet in the income statement is that we would have a current asset of $4,000 because we expect to receive that on January 1st, 2017. We would have long-term investments, debt investments, held to maturity in the amount of $93,537. Now remember, if we come back, that is what we have amortized up to. And then on our income statement, we would have the combined two interest payments in interest revenue of $9,259. Now, we only have in cash received $8,000 of it, but the remaining $1,259 is attributable to interest revenue as a result of being able to purchase this bond at discount. Remember, it's all comes down to intent and management's intent on how we report securities. Now, sometimes an organization will sell a security that they intend to hold to maturity. FASB defines when a company sells a security before actual maturity that it has constructively held it and doesn't actually violate the held to maturity requirements if the selling occurs very close to the date of maturity. So that interest rate risk is really not an important pricing factor. So if we sell it not too long before it would mature. When companies do this, though, they have to be very careful, because if they sell it too early, they may taint the entire held to maturity portfolio, meaning that their word, their intent no longer holds credibility. There is a potential belief that there might be some financial shenanigans occurring. If that is believed to be the case, the company may have to reclassify all the securities. And this could result in some significant changes to the balance sheet. So let's look here at the situation of a sale. And let's assume that they sell its investment in the Bush bonds on November 1st, 2020. Now, this is going to mature on 1/1/21. So it's still considered a held to maturity security because it is so close to maturity date. And they sell it at 99 3/4 plus any accrued interest. Z. Smith records the discount amortization in this way on that date. First, we have to calculate the amortization. So there's $952 of amortization that is left. We are 4 out of the 6 months through that last 6-month period. So $635 needs to be amortized to the debt investment. That is its real value for us. We recognize that as interest revenue. And then we move forward to the computation of the gain or loss on the sale of the bonds. So the selling price of the bonds, exclusive of the accrued interest, is $99,750. Remember, it was 99 3/4. The book value of the bonds on November 1st, 2020, had amortized cost for July 1st, 2020, the last time we received interest of $99,048. Then we have discount amortized through November 1st of $635, giving us a new book value of $99,683. Therefore, we have a gain of $67 on the sale of the bonds. We received cash of $102,417. We have interest revenue of $2,667. That is 4 out of 6 times 4,000. We have debt investments of $99,683. And the gain on sale is securities of $67. Now remember that the selling price of the bonds is the $99,750. We will also receive, when we sell it, the $2,667 of interest that has not yet been paid to us, but is our interest. That's how we receive $102,417. We will end this video here, and we'll talk about the available for sale securities in the next video. I encourage you to go back and reread this section and work through the bond amortization using the effective interest rate method. It's always good to have one of those tables pre-made for your use in homework or something of the like.